Hello, students. Welcome to our this second. In today's session, our discussion is about IFRS 16 leases as well as financial instruments, and we will cover IFRS 15. Revenue recognition. So these are the three standards which we are going to discuss in today's session. First of all, we are going to start the discussion about IFRS 16, which is about leases and what would be the expected accomplishment of this topic. We will discuss about the objective of this standard. We will talk about the scope of this standard. We will talk about definitions. We will talk about lessees accounting initial measurement. We will talk about lessees accounting subsequent measurement. We will discuss sale and lease back agreement treatment, and we will talk about some exam questions. So first of all, what is the objective of this standard? We are supposed to discuss that. Is to establish the principles for recognition, measurement, presentation, and disclosures of leases. So this standard is supposed to give you the guidelines about recognition criteria of leases, how leases will be measured, how it will be presented in your financial statements, and what are the disclosures required of what? Of leases. Okay. Now, the scope of this standard. This standard will apply to all leases, including subleases, except following thing. Leases to explore for or use mineral oil, natural gas, and similar non-regenerative resources. Leases of biological assets held by a lessee. Service concession arrangements and licenses of intellectual property granted by the lessor. And rights held by a lessee under licensing agreement for items such as films, videos, plays, manuscripts, patents, and copyrights within the scope of IS 38 intangible assets. So else these arrangements on all other sort of leases will be dealt as per the rules and guidance of IFRS 16. I would like to discuss the history of this standard. Previously, leases were dealt under IS 17, and over there it was classified as finance lease and operating lease. So there was misuse by the accountants to recognize about the things they were going to do, the window dressing. They were applying the creative accounting because alternative treatments were allowed. To manage that thing, this standard was introduced, and it replaced IS 17 leases. Now, these definitions are very important. First one, lease. What is lease? It is a contract. It is a contract or part of a contract. So first of all, we should have to understand what is contract. Contract is an agreement enforceable by law. Contract is an agreement enforceable by law. What sort of the contract lease is that conveys the right to use an asset, which grants the right to use an asset. It means physical, it transfers the physical possession of what? Underlying asset for a period of time in exchange for consideration. So, so lease is a contract. Contract is always for a specific time period, which is also mentioned here that it is for a period of time in exchange for consideration. Now, it is also a characteristic of every contract that there must be an element of consideration. You people are familiar because you have passed your paper F4, which is related to law. So here it is also required that there is an element of consideration. So it is a contract which gives the right of use of an asset to one party in exchange of consideration. Then lessor is the entity that provides the right to use right to use an underlying asset in exchange for consideration. So lessor is an entity which gives that right. So this is the party who is handing over the asset. On the other side, lessee. Lessee is the entity that obtains the right to use an underlying asset. So lessee is getting the asset, is receiving the asset, and lessor is giving the asset in exchange for consideration. So who are the parties of lease agreement? Lessor and lessee. Then right of use asset. A right of use asset is an asset that represents the lessee's right to use an underlying asset for a lease term. It is an asset upon which, due to this contract, lessee got the right to use that asset. In very simple words. Okay. Interest rate implicit in the lease. It is an interest rate that yields a present value of lease payments and the ungranted residual value equal to the sum of fair value of underlying asset and an initial direct cost of the lessor. So it is an interest rate which gives the present value of future lease payments equal to what? The fair value of underlying asset and an initial direct cost of the lessor. So the present value which you will get by discounting the future cash flows on this interest rate would be equal to what? Fair value of underlying asset plus initial direct cost of the lessor. These two things. So sum of these two things and the present value of future lease payments and ungranted residual value. Ungranted residual value we'll talk about later. Equal to the this. So that interest rate is called interest rate implicit in the lease. Lease term. This is non-cancelable period, first of all, which lessee cannot cancel. And for that, our lessor cannot cancel, which a lessee has the right to use an underlying asset. Plus, the period which is covered by an extension option. Now, what is option? This is the right to the holder of the option. It is the discretionary authority of that holder of the option whether he will use that or not. So option in a very general term is a discretionary authority. If exercise of that option by the lessee is reasonably certain, but it will be whether when extension option is available to the lessee and you are reasonably certain, it means chances of occurrence are more than non-occurrence that he will extend the time period and period covered by a termination option if the lessee is reasonably certain not to exercise that option. Now, one option is extension option that the lessee can extend the lease time period. Other is he can terminate the lease contract. But if you are reasonably certain that he will not terminate the contract, in that case, non-cancelable period plus extension period, if they will he will exercise, and you are reasonably certain for that, and termination period, which you are reasonably certain that he will never exercise. These three sums would be total lease term period. How lessee will do the accounting in his books. In paper FR, examiner is going to test you only lessee accounting. For this, what is the basic principle? At the commencement of lease, lessee should recognize a right of use asset and a lease liability. Now, lessee will do two things. First of all, he will recognize the asset with the title right of use asset, and he will recognize the liability. Now, journal entry would be right to use asset debit and lease liability credit and cash credit if he has made at the spot any payment. This would be the journal entry to recognize. Initial recognition is this. After that, initially it would be measured, right to use this, it would be measured at cost. So how cost will be determined? It will comprises initial measurement of lease liability, amount of initial measurement of lease liability plus lease payment made at or before the commencement date. If you have made any upfront payment, that is lease payment made at or before the commencement date. Any initial direct cost related to do that agreement, you will add, and the estimated cost of removing or dismantling the underlying asset as per the condition of the lease. This is again dismantling cost present value, but it will depend upon whether it is a part of agreement that you are supposed to dismantle or remove the asset at the end of the lease term period, then lease liability. Initially, it will be measured at what? Present value of lease payments that have not yet been paid. So it would be the present value of future lease installments. What could be those payments? Fixed payments and any amount expected to be to payable under residual value guarantee. Now, what is residual value guarantee? We will discuss later on. This is something new, incorporated by this new standard. Then option to purchase the assets that are reasonably certain to be exercised. If at the end of the lease term, lessee have an option to purchase that asset, and if he will exercise that option and he is supposed to make any payment, that will be also included to calculate the present value. And termination penalties if the lease term reflect the expectation that these will be incurred. If due to the lease agreement you have any penalty, you are supposed to pay any penalty as a lessee, then that would be also part of your future cash flows. What is residual value guarantee? It is a guarantee that is provided to whom? Lessor, that underlying asset at the end of the lease term will be worth less than that specified amount. So lessor is granting that at the end of time period, that your asset would not be less than this amount. So if market value of the asset would be less than that, in that case, lessee will buy that asset. He is granting that amount. That is called residual value guarantee. Example. On 1st January 2021, Dynamic entered into a 2-year lease for a lorry. The contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain to exercise this option. Lorries have a useful economic life of 10 years. Now, this is the 2-year contract for a lease, and there is an option to extend the lease term period for a further year. Okay. Now, Dynamic believes that it is reasonably certain to exercise this option. There is a reasonable certainty. So it means your lease term period would be first 2 years of original contract plus 1 year of that lessee will exercise the option. Its economic useful life is 10 years, which is more. Lease payments are $10,000 per year for initial term. Initial term is these 2 years plus 15,000 per year for the option period, which is only 1 year. All payments are due at the end of the year. To obtain the lease, Dynamic incur initial direct cost of 3,000. Interest rate within the lease is not readily determinable. Dynamic's incremental rate of borrowing is 5%. Now, this is the implicit interest rate. Required, calculate the initial carrying amount of lease liability and the right of use asset and provide the double entries needed to record these amounts in dynamic financial records. Now, first of all, lease liability. We will calculate the present value of all future lease payments. These are 10,000 for year 1, 10,000 for year 2, and 15,000 for year 3. This is the option time period. This is the original contract period, non-cancelable time period. 0.952 discount rate for first year at the rate of 5%, which is calculated by 1.05 x raised power minus 1, 1.05 x raised power minus 2, and 1.505 x raised power minus 3. So these are calculated. We multiplied this with this and we got this figure, and so on. This is the present value. So at this value, you will record your liability. Then right to use asset. It would be, you must have to remember that 3,000 was incurred at the initial start. Lease liability 31,552 plus direct cost, which is 3,000. So your right to use asset total value would be 34,552. Journal entry would be, please mute your voice. Right to use asset 34,552 with this figure. 2. Credit lease liability with 31,552, which we have calculated, plus credit cash with 3,000. Okay, let's see accounting. Subsequent measurement. Now, right to use asset will be depreciated using cost model. As we have discussed in last day's session under IS 16. And at which time period we will depreciate our asset. First of all, if you are certain that at the end of the lease term period, the ownership right of the asset will be transferred to the lessee, then it would be charged over the useful life. Otherwise, depreciation would be charged over the shorter of useful life or lease term, which is normally lease term period, is shorter than useful life. Then lease liability. Every year, lease liability will be calculated by which is increased with the interest charge and reduced by cash repayment. Now, how it will be calculated will depend upon at which date your lease term is started. When interest charge, what would be the journal entry? Then finance cost debit and lease liability credit. When cash paid, lease liability debit to cash credit. So these are the journal entries once you are doing the subsequently payment and charging the interest cost. Now, this is the table which I was supposed to discuss with you. The first possibility is that lease installment is made in arrear at the end of every accounting period. In that case, your format would be this: at year one, balance brought down, starting balance plus interest, which calculated by multiplying rate with this amount, minus payment and closing balance. And next year, this would be the opening balance. And then again, interest will be calculated by multiplying this with interest rate. Then you subtracted the payment, and then this is the closing balance. But keep in mind, for lease liability, you are supposed to distinguish between current liability and non-current liability. We'll discuss later on. When payment is made in advance, then format would be bit different. Year one, opening balance minus payment, because all payment is done from this, then subtotal, and then you will charge interest on this subtotal by multiplying with the interest rate, and then you will add this interest rate to calculate the closing balance. Then this closing balance would be next year opening balance. Again, you will subtract the payment, then the subtotal will come, and you will calculate the interest on this subtotal. Now, the summary of this thing is, if your payment is in arrear, on opening balance, you will calculate interest, then you will subtract the payment. But if your payment is made in advance, then first of all, you will subtract the payment, then the balance which comes after subtracting the payment, you will calculate the interest on that figure. Example, same example, 3 years term lorry, and for first 2 years you have 10,000 payment per year, and the next year you have 15,000, and you have direct cost 3,000. Interest rate is 5%. You are supposed to prepare the extracts for the first year and 31st December 20x1, extracts of statement of financial position and statement of profit and loss. Solution. Now, first of all, we'll calculate the depreciation. We have decided that the depreciation will be calculated at shorter of lease term period or useful life. Useful life in this case was 10 years, but lease term period is 3 years. So this is the right to use asset value. 31,552 was a liability plus 3,000 initial cost. So 34,552 divided by 3 is equal to 11,517. Now, second section is about lease liability table, from where we will calculate the interest. Now, payment was in arrear. So opening balance was 31,552, which is the present value of future lease installments we have calculated in previous example, which is 31,552. We calculated interest on this figure, which is multiplied with 5% equals to this. Then we subtracted the payment, and this is the closing balance. And from there, this is the opening balance. Again, what we have done, we calculated 5% interest rate is equal to 1557, then subtracted the lease payment, it is 14,287. Okay, now from this 14,287, we calculated at 5%, it is 713, and last year you made the payment of 15,000. Now you have closing balance nil. Now, how you will do the extract? First of all, statement of profit and loss, depreciation calculated in working one, then finance cost, which is calculated in working two for this year, 1578. Now, statement of profit and financial position for that non-current asset, original cost was how much? 34,552. Now, 34,552 out of this 11,517 is depreciation. Then your carrying value is 23,035, which is calculated 34,552 minus 11,517. In this way, this is calculated. Then non-current liabilities. Now, I have discussed with you that this is your total liability at the end of the accounting period. Out of this, the principal which you are going to pay in next accounting period would be your current liability, and remaining figure would be non-current liabilities. So this is your non-current liability. Yes, Shagufta, it would be available on my YouTube channel, which is Arshad Bhutta Official. And if you will drop your WhatsApp number, I'll share the later on study notes, these PPT files, as well as on my YouTube channel and on VIFHE official YouTube channel, you will find these lectures. My YouTube channel is Arshad Bhutta Official, which you should have to subscribe if you will go on YouTube, and also VIFHE. VIFHE YouTube channel is with the name of VIFHE. Okay. Drop your WhatsApp number to me through chat box. Okay. Now, 5%, 1557. This is the interest rate for interest cost for the next year. Now, from these two figures, this is your non-current liability for non-current liability because it is payable after 1 year. But the difference of these two, 23,130 and 14,287, would be your current liability because it is payable. You can calculate by getting the difference of these two figures, or from your total installment payment, 10,000. If you will subtract your interest cost, if you will subtract your interest cost, again you will find this figure, say 10,000 minus 1557, it's this figure, or 23 130 minus 14287. Again, this is the same figure. Okay, keep in mind, this is the uh, bit complex scenario that examiner is always asking you to split your non-current your liabilities into non-current components and current components. Say for next year, if you are supposed to prepare the extracts at the end of second year, then you don't have any non-current liability component. You have only current liability component because at the next year your lease term period will be finished, contract will be exhausted. Okay. Now, what to do? This is the new development in IFRS 16 as compared to IS 17. You may have some short life and low value assets. What are the short life assets whose life is less than 12 months? And low value assets for these standards says uh, that does not specify any specific monetary value, but normally what is the practice? These are the assets those value is less than dollar 5,000 US $5,000. Those are considered as low value assets. But he has given some examples to us: tablets, small PCs, telephones, and some all items of furniture. These are considered as low value assets. So standards says that it's accounting treatment. If you have short life or low value asset, you can use simplified treatment, which is lessee can choose to recognize the lease payment in profit and loss on straight line basis. No lease liability or right of use asset would therefore be recognized. What you will do, you will simply expense out your lease payments, and you will never recognize any right to use asset or any lease liability. Then our next discussion is about sale and lease back. Okay. Now, sales and lease back. What is this? That you are the seller, you sold your asset to buyer. Okay. Let's assume this is the vehicle which seller have sold to buyer. Now, first transaction is of sale and purchase. But buyer don't take the physical possession of the asset, and he transferred this vehicle again to the seller. He got this asset at lease back through lease contract. So this is called sale and lease back. Now, what is the question mark? First of all, we should have to consider whether the transfer of asset is sale or not. If yes, if it is sale, in that case, what lessee will do, first of all, he will recognize the gain on the sale of the asset, on the disposal of asset, and will recognize back as a right to use asset, because now he is lessee also, because he got the asset on lease. Okay, recognize right of use asset at proportion of previous carrying value, but through which value? Through previous carrying value. Okay. Okay. And on your previous sale, you will recognize your gain or loss like you were recognizing on any asset disposal. But on the other side, if it does not constitutes as a sale, in that case, you will never de-recognize your asset. You will recognize your previous asset, and the lease you will treat it as a loan, as a financial liability under rules of IFRS 9, which we will discuss in today's session also, as a financial liability. Example, on 1st January 2001, painting sells an item of machinery to college for its fair value of $3 million. The asset had a carrying amount of 1.2 million. Now, at which uh, value he sold 3 million, and its carrying amount is 1.2 million prior to the sale. The sale represents the satisfaction of performance obligation in accordance with IFRS 15. Revenue from contracts with customers. Painting entered into a contract with the college for a right to use the asset for the next 5 years. Annual payment of 500,000 are due at the end of each year. The interest rate implicit in the lease is 10%. Keep in mind, in your paper FR, implicit interest rate will always be given to you. The present value of the annual lease payments is 1.9 million. So what he did for these lease payments, he has already calculated your present value. You are not supposed to calculate it by using this discount rate. Now, he said that as per the rules of IFRS 15, this sale satisfies that it is a sale. So what lessee will do, first of all, he will record the sale, and then he will record the asset as a right to use asset and also lease liability. The remaining useful life of the machine is much greater than the lease term period. So we will depreciate on lower half, which is lease term. Depreciation would be charged on this basis. Required. Explain how painting will account for the transaction on 1st January. He is just asking you to account for at 1st January 20x1. Now, for this purpose, but we have solution. Painting must remove the carrying amount of the machine from its statement of financial position. It should instead recognize a right to use asset. New asset will be recognized as a right to use asset, and old asset will be de-recognized. The right of use asset will be measured as the proportion of the previous carrying amount that relates to the rights retained by paintings. Now, how you will calculate it? It would be in proportion. 1.9 divided by 5 times 1.2 million. Now, what is this? It is equal to 0.76. 3 million is the fair value of the asset, and its carrying value is 1.2 million, and present value of future installments is 1.9 million. So this would be recognized in proportion of this. So 3 million, 1.9 million divided by 3 million multiplied by 1.2 million. You can also write down 1.2 divided by 3 multiplied by 1.9 equal to 0.76. And what would be the journal entry? Right to use asset at 0.76 proportionately. This is the thing to your fair value and carrying value. Debit cash 3 million, which you have received. Credit machine at 1.2 million, which you have de-recognized. and lease liability 1.9 million, which is the present value of future cash flows, and gain or loss, it would be the balancing figure. So if you will balance out this, there is a gain. Okay. Can you please, sorry for interruption. So this was the whole discussion about lease term period. Yes. If lease back is not a sale, in that case, you will never de-recognize your asset. You have recognized and you will charge normally your depreciation. Then journal entry would be cash debit, which you have got today, and your loan liability credit. It is simple a loan, nothing else. Okay? Aska, you got this point? Please mute your voice. The amount which is you are getting right now, which is in if I will go with the same scenario, then just then it would be, if it is the same scenario, that would be the amount. Asset carrying value is 1.2 million, but its fair value is 3 million, and you have sold this figure for this amount, because this is the consideration which you are getting 1.9 million in 2 days term. So your liability would be from very first day with 1.9 million. Okay, so that would be constituted as your loan. This would be the figure, 1.9 million. Okay, so this is the benefit which you are getting. Clear? So this was the whole discussion. Okay. Yes, students, now we are going to discuss another important area, another important topic, which is financial instruments. Okay. What we will discuss relevant standards, definitions, financial liabilities, classification of preference shares, compound instruments, financial assets, offsetting, and derecognition. So this would be the factoring of receivables and disclosure requirements. These are the areas which we will discuss in this standard, in this topic. Relevant standards: IS 32, financial instruments presentation; IFRS 7, financial instruments disclosure; and IFRS 9, financial instrument. So these are the three standards. Those are dealing with financial instruments. So this is the combined lecture, and these study notes are developed by focusing what examiner is requiring about these topics in paper FR. Okay. Now, first of all, important definitions. First definition is about financial instruments is also a result of contract, any contract. So financial instrument is any contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. So due to this contract, one entity is getting financial asset and the other entity is bearing either financial liability or getting equity instrument of another entity. So that is a contractual arrangement. Due to that arrangement, there is a rise in financial assets of one entity and financial liabilities or equity instruments of another entity. Financial assets. Financial asset is any asset that is either cash or a contractual right to receive cash or any other financial asset from another entity. It is a cash or a right to receive cash or any other financial asset from another entity. So due to that right, you will get either cash in future or you will get another financial asset of any other entity and a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable. So, a contractual right to exchange financial asset or liabilities with another entity under conditions that are potentially favorable. So, due to this contract, you will exchange the financial assets and liabilities with another entity which is favorable to you. So, that is also called financial asset, an equity instrument of another entity. And due to this uh, transaction, this contract, you are getting the equities of another entity. So see, these are all your financial assets. Then financial liabilities. Any liability that is a contractual obligation. Due to this contract, you have now obligation to deliver cash. What sort of obligations? To deliver cash or any other financial asset to another entity or to exchange financial asset and liability with another entity at potentially unfavorable, those are not favorable to you, terms that will or may be settled in entities own equity instruments, or it would be settled by issuing your equity instruments to someone else. Okay, then equity instruments, it is a residual interest of in the assets of an entity after deducting all of its liabilities. So equity instrument is any contract that gives you the residual right in the assets of another entity after deducting all of its liabilities. That is called your equity instrument. So this is the balancing figure. Total assets minus total liabilities is equal to equity, you know. So equity instrument is a contract. Due to that, your residual right in the assets of another entity will increase. Then compound instruments. These are the instruments uh, that has both characteristics of equity and liabilities. It is compound instrument is any financial instrument that have some characteristics of equity and some characteristics of liabilities, such as convertible loans. Financial liabilities, initial recognition. A financial liability is initially recognized at its fair value. So initially it will be recognized at fair value. First of all, we are talking about recognition of financial liabilities. How fair value will be determined for financial liabilities? Net proceeds minus any issuance cost. So that is the figure which is called fair value. Initially, your liability will be recognized at fair value. Then subsequent measurement, this is important. Financial liabilities will be carried at amortized cost. What is amortized cost? Initial value, which we have determined in previous slide, which is your fair value, that is equal to net proceeds minus issuance cost. That is your initial value. Plus effective interest. Now effective interest rate is different from nominal interest rate. Why? Because there is a possibility that you may be redeeming the liability at premium, or you have issued the liability at discount but redeeming it par. So effective rate would be different from nominal rate. Minus interest paid. Interest paid is always calculated at coupon rate, or which is called nominal rate. And effective rate, interest, which is your actual interest cost, is always calculated at effective interest rate. Then the figure which you will get, that is your amortized cost. Exception to this rule. Now, normally what happened, subsequently your financial liabilities are carried at amortized cost. But what is the exception? If your financial liability is held for trading, then there is a deviation from this principle. Okay? And derivative liabilities. Both are not part of the syllabus of FR. These are These both are charged through fair value, through profit and loss. But this is not part of your syllabus. So how that is calculated? But it is charged on which method? Fair value through P and L. But how its calculation is done, it's not part of syllabus. So we are supposed to only discuss the financial liabilities through amortized cost. Then what is effective interest rate? As I discussed earlier, it is different from nominal interest rate because there is a possibility that the financial instrument may be issued at discount or redeemable at premium or issuance cost, etc. How interest paid calculated? As I discussed earlier, it is always calculated principal amount times nominal interest rate. And how interest expense calculated? Balance times effective interest rate. Now in paper financial reporting, effective interest rate you are not supposed to calculate. It will always be given to you in the questions. Okay. Then classification of preference shares. No fixed payment. Then it is classified as equity. If you don't have any fixed payment, normal, what is the feature of preference shares? There is a fixed payment. But if you don't have any fixed payment, in that case, it will be considered as considered as equity. But if you have fixed payment, in that case, it will be classified as debt. It means it will be your liability, financial liability. And if no fixed payment, in that case, it would be your equity. Yes, Charlie, you will get. Then classification of interest and dividend. Classification of interest and dividend will depend upon classification of underlying financial instrument. Now, if that is your debt instrument, like we have discussed for preference here, if you have fixed payment, on your preference share. In that case, it is your liability, and at that liability, you will charge interest. So your finance cost will go where? In statement of profit and loss. Your interest cost will go where? In statement of profit and loss as a finance cost. On the other side, if you have preference here, it will be dependent upon classified as liability, finance cost in SPL. If it is classified as equity, dividend in equity section. So in that case, the payment against preference shares will be considered as preference dividend. But if it is classified as liability, the dividend would be classified as finance cost, and that instrument's finance cost in SPL. Then this is the hot favorite area for the examiner: compound instruments, convertible loan characteristics. First characteristic is it is repayable at the lender's option in shares of issuing company instead of cash. So lender have an option that he may repay the cash or he can buy the shares of the issuer. The number of shares to be issued is fixed at inception of the loan. Once you got the loan, once you entered into contract, at that time period, it is predetermined that how many number of shares you will get against a certain amount of your debt. Say 2 shares for every $100 or $1,000 whatsoever. So this is the predetermined ratio, which is determined at the time of inception of contract. Okay. Now, lender will accept a rate of interest below the market rate for non-convertible instruments. Now, look, due to this, the person who is giving the money, he may give the money at a lower rate of return, because he is getting the option to convert the loan into equity later on. Okay. Now, how this compound instrument is accounted? It is accounted using split accounting method. It is accounted using split accounting method. There is a liability or debt element as the issuer has potential obligation to deliver cash. It means in this compound instrument, there is a once portion of liability or debt, because the issuer, the borrower, is obligatory to deliver the cash in the future. And there is also an equity element, because investor may choose to convert the loan into shares instead. He has the right to convert the loan into equity. So it has equity element as well as debt element. How it is considered? Initially, how it will be recognized: debt or liability element will be recognized at future fair value, which is the present value of future cash flows. What are the future cash flows? Principal and interest. Both present value would be the fair value, and residual value would be your equity, which is loan proceeds amount, total amount of loan minus debt value, which we have determined this. So this, the present value of future cash flow, you will subtract from your total loan amount Remaining portion, if any, would be residual value. Let's assume loan amount is 300,000 and present value of future cash flows is 290,000, let's assume. So your debt element is 290,000. This is your debt. And loan proceeds are 300,000 minus 290,000. 10,000 is your equity. Okay. Subsequent measurement. Debt and liability is at amortized cost, and which is initial value plus effective interest minus interest paid, and equity value don't need to reinstate, not remeasured. So equity will remain same, which we have calculated at start, but that value would be calculated using amortized cost. So initial value, which is 290,000, say on this your effective interest is 10,000 and you have paid 5,000. So next year your total amount would be 295,000. Okay. Financial asset, other side, initial recognition. When financial assets will be recognized like any other asset, when you will become the party to the contractual provision of the instrument. Once you will become the party, at that time, it is probable that in future you will get the economic benefit and cost can be measured reliably. So you will recognize your financial assets once you will become the party of the contract. Then at which value? Fair value. That is purchase consideration plus transaction cost. What is the exception to this rule? Normally, what happens that financial asset will be recognized initially at which value? Fair value. But exception to this rule is fair value through SPL. If it is fair value through SPL, then transaction cost will never be capitalized. Then only purchase consideration would be considered as fair value. Now, if your financial assets are equity instruments, then you can either recognize fair value through P&L. In that case, this would be the case. Fair value through SPL, this would be the case. It means you will only capitalize purchase consideration. For if you have investment in equity instruments, you have two options: fair value through P&L and fair value through OCI. Now, what is the default category? Fair value through PL. It means only your purchase consideration will be capitalized. This is not a default category, but for what? But to apply this category, what we will do, we will talk about later on. As I discussed earlier, fair value through P&L, what we will do, only purchase consideration will be capitalized. Transaction cost will be expensed out. Later on, any gain or loss at the end of every accounting period will be charged through SPL. If your fair value go up at the end of the accounting period, there is a gain which will be charged to statement of profit and loss. If fair value goes down, there is a loss which will be charged to statement of profit and loss. But if it is fair value through OCI, it means transaction cost will also be capitalized. It must be done at point of acquisition. It can be done only if intent is to hold investment for longer term period. So fair value through OCI, we will only use for if you have investment in equity instruments, once you have an intent to hold the investment for a longer term period. Transaction cost will also be capitalized. with purchase consideration. Investment revalue at the end of each accounting period, and gain and loss will be shown in investment reserve in equity section. Gain and loss will not be charged to statement of profit and loss. This is fair value through OCI. And reserves cannot be negative. There is always a credit in reserve figure. Then if you have made investment in debt instruments, then fair value through P&L, this is the default category. Fair value through OCI or amortized cost. Default category is again for this is also fair value through P&L. Fair value through other comprehensive income or amortized cost is not a default category. So when these two categories are used for that purpose, we will apply two tests, business model test and contractual cash flows characteristic test. And by the application of these two tests, we will decide whether we will go through fair value through OCI or through amortized cost. P&L transaction cost will be expensed. Purchase consideration would be your interest investment capitalized. Again, revalue at the end of each accounting period, gain and loss through SPL. Then debt instruments, amortized cost. For amortized cost, first of all, we will apply business model test. What is business model test? The entity must intend to hold the investment to maturity. If you have a intent that till the redemption of the loan, you should hold the investment, and then business model test. Your contract will give you the right for cash flows. What are those cash flows? Principal and interest. What you will get in the future on, you will get your principal amount at the end of the term period, and annually, semi-annually, or quarterly, you will receive the interest. If these two models will be applied, then you will use the amortized cost, and for that you will use the amortized cost table for subsequent value measurement. Now there is only one change which is under business model test to apply fair value through OCI. That is this statement, but may sell the asset if the possibility of buying another asset with a higher return period. Normally, still you have intent to hold the investment till maturity. But if you have in your frame of mind that if any other investment will give you the higher return than this, then this business model will be applied and you will go through fair value through OCI. And business contractual cash flows test, this is the typo mistake, sorry. Are solely principal and intent. So only this is the area which will change your category from amortized cost to fair value through OCI. So in your MCQs, be vigilant about this statement. Transactions cost also capitalized along with purchase consideration, because transaction cost only expensed if it is fair value through P&L. Interest income will be shown in statement of profit and loss, and investment revalued at the end of each accounting period. Gain and loss will charge through OCI, other comprehensive. Now, can we offset our financial assets with liabilities? This is the question. We can do the offsetting in a very limited circumstances. Normally, it is not allowed. What are those circumstances? Net amount may only be presented in statement of financial position when the entity has a legally enforceable right to set off the amounts. law of that jurisdiction is allowing you to offset, then you can offset, or intent either to settle on a net basis or to realize the asset and settle the liability simultaneously. And second thing is, law is allowing you, and you have intent to ultimately settle the transactions on net basis, say from deducting financial liabilities from financial assets, net figure you will receive. Or if your financial liabilities are more, then you will settle the balancing figure of liability. Or you want to settle both things, settle the liability and to sell the asset at the same time period. In that case, you can do the offsetting. Otherwise, no. When you will de-recognize your financial, please mute your voice, please. When and only when your contractual rights to cash flows from financial assets expire. Please mute your voice, students. And financial liabilities. When you have discharged or cancelled or expire your financial liability, at that time you will de-recognize your financial liabilities. If you have any gain or loss when you are de-recognizing your asset, will be charged in statement of profit and loss. That will be gain or loss where it will be charged in statement of profit and loss. Now, this is another important topic. Factoring of receivable. What is factoring? Factoring is like when one company is transferring the management and collection of its receivables to another company. Okay, that is called factoring. What is the key question here? Is the seller who is selling his receivables to other company substance receiving a loan on the security of the receivables or the receipts on actual sale of those receivables? Now, whether he is getting just a loan or whether he is selling his receivables, these are the two questions. For that purpose, what is the key criteria? Risk and rewards associated with receivables to whom those are transferred. Like, what is the risk? Payment is deferred or payment becomes irrecoverable, bad debt. In that case, who is bearing this risk? If the seller is bearing that risk, then no sales. If factor is bearing that risk, then there is sale. Now, say first arrangement is sale with recourse. In that case, risk associated with the seller. Factor can return any unpaid debt to the business, and meaning that business retains the risk of irrecoverable debts. No sale. Transaction is treated as a secure lien against the security of your receivables rather than a sale in return. Okay. And sale without recourse, it means factor is bearing the risk. The factor bears the risk of irrecoverable debts. Transaction is treated as a sale and receivables are removed from the entity's financial statements. What are the disclosures? The carrying amount of each class of financial instruments must have to be shown in the notes to accounts. Financial instruments, relevant income, expenses, gains, and losses, you have to recognize whether those are charged to statement of profit and loss or OCI. Okay. And you are supposed to also disclose about the risks faced by the entity. Okay. These are the disclosures relevant to this. That's all for financial instruments. Now just hold for a while. Students, now we are going to discuss another important standard, which is IFRS 15, revenue from contracts with customers. What is the agenda of this session? We will talk about the objective of the standard, scope of the standard, definitions, the 5 steps model. Then we will talk about the presentation in your financial statements. Objective. What is the objective of IFRS 15? Is to establish the principles that an entity shall apply to report useful information to user of the financial statement about what? About nature, amount, timing, and uncertainty of revenue and cash flows arising from our contracts with the customer. What is the background of this standard? Previously, there were 2 standards. Those were dealing how to recognize your revenue from contracts with customer. One was IS 18, which was dealing with the revenue from general course of sales as well as dividends and interest you are receiving on your investments. And there was another standard that was IS 11, construction contracts. So over there was no unanimous treatment to recognize your revenue. For that purpose, this new standard, and it is also result of like IFRS 16 of convergence with IASB and US GAAP. International Accounting Standard Board and US GAAP have commonly issued these standards to give the same sort of. Please mute your voice, please. Students, please mute your voice. It is my humble request, kindly mute your voice. Scope. What is the scope for revenue from contracts with customers? It applies to all contracts with customers. It will apply to all contracts with customers except for leases, because that is a contract separately we have discussed under IFRS 16. Insurance contracts, which is dealt under IFRS 4, which is not in a scope of the syllabus of paper FR. It is discussed in strategic business reporting. Financial instruments we have discussed under their relevant standards, IS 32, IFRS 7, IFRS 9, and non-monetary exchange between entities in small lines of businesses. So all these areas, all sort of contracts with your customers, and the revenue which you are getting from those contracts is accounted for as per the rules of IFRS 15. Definitions. First one is of contract. Contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Contract is an agreement between 2 or more parties, as we have discussed already. Then customer, a party that has contracted with an entity to obtain goods or services that are output of an entity's ordinary activities in exchange for consideration. Let's assume, what are the ordinary activities of VIFHE? They are providing training and coaching services for professional certification students. Now, You guys are a customer because you are contracting with VIFHE to get the services, which is normal output of entities' ordinary activities of VIFHE in exchange of consideration. In form of consideration is in the form of payment which you are doing to them. Okay, so if that is happened, you are paying your fee to Wi-Fi, they are giving you the services. This is in that case, you are getting the services, you are the customer. Then income, increase in economic benefits during the accounting period in form of inflows or enhancement of assets or decrease of liability that result in an increase in equity other than those relating to contributions from equity participants. Who are equity participants? Shareholders, owners. If increase in equity is due to the contribution from shareholders, their company has issued the shares and they bought the shares and there is inflow, that will not constitute as income. But if your equity increased due to the provision of ordinary operations, goods or services, and due to that, overall assets of the entity goes up or its liabilities goes down. Let's assume, as being a trainer, I am representing Wi-Fi, and you have say enrolled yourself in one paper, and later on you asked to for refund that amount. So it means Wi-Fi has obligation to you, and Wi-Fi offered you that you should enroll in another course, and your fee is adjusted. And due to that, the liability of Wi-Fi goes down. That is Wi-Fi income. Okay. Performance obligation. A promise in a contract with a customer to transfer the customer either a good or service that is distinct or bundle of goods or services. Performance obligation is the promise in a contract with whom organization is promising with customer for what, that you will transfer to customer a good or a service or bundle of goods or services that is distinct, can be distinguished from others, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. Or it could be one good or service, or could be series of goods or services. For instance, uh, uh, provision of uh, electricity to your to customer by the electricity provider. Same sort of good is provided from time to time on series of periods. Okay. Then revenue, income arising in the course of an ordinary activity. Revenue is any income which is arised in an ordinary course of activities. Income arise due to the activities which you are providing in your daily routine. Like Wi-Fi is providing the coaching to the students in ordinary, as ordinary activity in its daily routine. Then what is transaction price? This is the amount of consideration. Consideration is something in exchange of another promise to which an entity expects to be entitled in exchange for transferred promised goods or services. So transaction price is the amount which you are receiving against the promised goods or services to customer, which is excluding any amount which you have collected on behalf of third parties. For instance, this is what I want to explain you, amount collected on behalf of third parties. let's assume uh, you are working as a consignment agent. It means you are selling the goods on behalf of someone else. So in that case, if you are collecting the amount on behalf of someone else, that would not be constituted as your transaction price. Then 5 steps model. First one is identify the contract with the customer. Second thing is, even though examiner can ask you to sequence this model, identify the separate performance obligation in the contract. Then third step is determine the transaction price. Then fourth one step is allocate the transaction price to the separate performance obligations. And then fifth one is recognize revenue when and as the entity satisfies a performance obligation. Recognize revenue when or as the entity satisfies a performance obligation. Now, what are the 5 steps? First of all, identify whether you have contract with customer or not. Identify the different separate performance obligations in the contract. Then determine the total transaction price of whole contract. Then allocate the transaction price to different performance obligations which you have identified in step 2, and then check in final step whether that performance obligation has been satisfied or not. Once it is satisfied, then you will recognize your revenue. Step 1, identify the contract with customer. Agreement between the seller and buyer to provide goods and services in exchange of consideration. Once there is agreement, there is a contract. Contract could be oral, written, or implicit understanding between buyer or seller or customary practices. Now, what is customary practices? That is the practice which you are doing from previous time to time to time, and it is like a custom of that sort of business. Okay. Then, what are the additional criteria? Is there is a commercial substance or not? But principally, this is the major element. Commercial substance protective clause. It is commercially, there is a commercial value of that transaction or not. Commitment by the both parties. Here we will check whether the commitments made by the both parties are legal or not. Identify the rights of parties. Payment terms are identified, not necessarily fixed, and collection is probable. These are the subsidiary terminologies, conditions. Ultimately, if agreement exists between buyer and seller to provide goods and services in exchange for consideration, that is a contract. There is a contract. Identify the separate performance obligations in the contract. The entity must evaluate all the goods or services promised in the contract to determine whether there are separate performance obligations or not. How many obligations do you have in the products? First of all, 1 or 2 or 3. Identify how many performance do you obligations do you have. Then please mute your voice. How many obligations do we have in the product? 1, 2 or 3. Check. Is the product distinct? When it is distinct, when you can sell it separately, then it is distinct. Are you transferring an individual product or separate products? Only one product you are transferring, then only one performance obligation. If you are transferring many products and separately, then so many performance obligations do you have. Examples: coffee and bagels. It's a one contract, but we have two separate and independent product obligations. Contract is one. You ordered at a coffee shop coffee and bagels. Okay, you ordered coffee and bagel. It is a one contract. On the other side, you ordered large latte. It here products are interdependent or interrelated products, two separate products, but one obligation. Now, irrespective of two separate products, milk and coffee, but your obligation is same. You can't present it separately, but here coffee and bagels, this is bagel. So here one contract but two performance obligations, and here two separate products but only one obligations. So if you have two separate performance obligations, let's assume you just uh, served coffee to your client but still not served bagel, he can claim you the bagels, or he will subtract that amount from your total price. But in latte, it's only one performance obligation because you can't serve the both products separately. It is part of that one thing. Then you will determine the transaction price. If it's a cash transaction, say you went to the bookshop, you asked to the bookshop keeper to give you the Caplon study text for paper FR, and you are making the cash payment over the counter. It's a very easy transaction. If you have deferred payments, you have deferred payments. In that case, discount to present value. You are supposed to discount it to present value. Then variable, there is a possibility that your cash involvement would be variable. Consideration is not fixed. Say you may have discounts, concessions, or rebates. In that case, you will use expected value and are most likely amount to determine the transaction price. Examples: XYZ construction company enters into a contract with the customer to build a warehouse for 200,000 with a performance bonus of 100,000 that will be paid based on timing of completion. The amount of performance bonus decreases by 5% per week every week beyond the agreed date. XYZ construction have already performed such type of contracts. On the basis of history, management believe that 70% probability is contract will complete on due date, 20% probability that contract will complete in 1 week delay, and 10% probability that contract will complete in 2 weeks delay. Now you will calculate the expected value for your bonus amount. How? 70% is will complete within one time period. So performance bonus is 100,000. 100,000 times 70% is equal to 70,000. 20% that it will be delayed to the next 1 week. So in that case, 5% will be decreased. So your net amount would be 95,000 times 20%. How much it comes? 95 times 0.2 is equal to 19,000, and then finally it will again reduce by the 5%, so it is 90,000, and its probability is 10% is equal to 9,000. So you will make the total 70 plus 19 plus 9 is equal to 98,000. This is the expected value of your transaction price. Okay. Allocate the transaction price to separate performance obligations. Please mute your voice, students. Transaction, transaction price, excuse me, transaction price should be allocated to the separate performance obligations in proportion to the stand-alone price of each element of contract. Now, the total transaction price will be allocated to each performance obligations according to the proportion of their standalone price. What is the meaning of this standalone price? Standalone price means the price which you will charge if that would be the only contract, only performance obligation in the contract. Say example, cell phone and cellular connection for 2 years are, excuse me, mute your voice. Now, this is cell phone and cellular connection for 2 years. Now, what they are offering, say, let's assume they are giving you the package in 15,000. Excuse me. Otherwise, I will remove you guys from the class. Please mute your voice. Who is that? 15,000 is the price which you are offering. Now, if you will buy the cell phone individually, it can you get in 13,000. And your cellular connection for 2 years, you can get in 7,000. So if you will individually buy these two things, your total value would be 20,000. But in this one contract, you are getting these two sort of things, cellular connection for 2 years and cell phone in combo price, which is 15,000. Now you will allocate this to both performance obligations according to their proportion of their standalone value. For example, cell phone value will be calculated 15,000 divided by total value of standalone price 20,000 times 13,000. So in this portion it have been charged. So 15 divided by 20 times 13 is equal to 9,750. Now this price will be determined to cell phone, and once you delivered the cell phone to your customer, it will be recognized as your revenue. And now cellular connection for 2 years value would be connection equal to 7,000 divided by 20,000 times 15,000. Oh, sorry, it's times 13,000 because, oh, yes, times 15,000 because total price is 15,000. So 7 divided by 20 times 15,000 is equal to 5250. Now this is for 2 years contract, cellular connections. At the end of first year, you will recognize 50% of this because that performance obligation is satisfied. Like other example is of burgers. So you are going to McDonald's, they are giving you the deal where you have burger, where you have fries, where you have soft drink. So if you will buy separately, their price would be higher. So you will charge according to their standalone prices. Allocate the transaction price to separate performance obligation. Now, these are the approaches. Those are, I am a bit sure that examiner will never test in paper FR, but I'm just giving you the quick review. When goods or services are not sold separately, the transaction price must be allocated to separate performance obligation using reasonable approach. If you can't sold separately, it means you are not getting the standalone price. It can be sold only as a combination, as a combo group. In that case, you can allocate the price to different performance obligations on following of these three bases. Adjusted market assessment approach: check the price from the companies those are competitor and providing the similar goods and services. Adjustments could be required. Our expected cost plus market approach: you will determine the total cost of every performance obligation plus desired profit margin. You will adjust. A residual approach: let's assume your total combo package is of 4 performance obligations. Out of these 4, for 2 performance obligations, you can determine the standalone price. And from that, you will determine the two performance obligations transaction price on the basis of standalone price, and remainings you will charge as a residual figure. Now, recognize the revenue when each separate performance obligation satisfied. First question is when satisfaction occurs. It could be in point in time or point over time. Now, point in time, if you have one single performance obligation, say as I discussed with you that you went to bookshop to buy the FR Kaplan study text. So over there, it is a point in time. Point over time where you have series of transactions to be performed over a time period. Will be checked from customer perspective, not from the seller perspective. It will always be checked through customer's perspective. What is the criteria to determine whether performance obligations are satisfied or not? First of all, after transferring goods or services, whether you as a seller has a right to payment of the asset, whether you have transferred your legal title of the asset, whether you have transferred physical possession of the asset, significant and risk and rewards of the assets transferred to the customer, and customer have accepted the asset, then you will say that performance obligation has been satisfied. And once it is satisfied, you will recognize your revenue. Recognize the revenue when each performance obligation is satisfied, as discussed earlier, specific point of time or over a period of time. It could be done. How it will be presented in your financial statements. Over there, in step 1, we will calculate the overall profit and loss. In step 2, determine the progress of the contracts. This is where you have series of performance obligations events to be occurred. Presentation in statement of profit and loss, and presentation in statement of financial position. So this occurs normally when you have construction contracts. First of all, you will calculate the overall profit or loss of your whole project. Then how it will be calculated? Contract price, which you have determined for the whole series of performance obligations. Then you will subtract your cost of contract. Now keep in mind, if you have loss could be recognized immediately. How cost of contract is determined? Cost incurred to date, which you have actually incurred, plus estimated cost of completion of that project. Subtracted if your revenue contract price is greater than your cost, that is your profit. And if your cost is greater than your contract price, that is your loss. Then determine the progress of contract. Over there, two methods are used. One is input method and the other is output method. Normally, this method is used, which is a simple, you will calculate the stage of completion by contract cost incurred to date as percentage of total expected cost. And output method is, it would be determined what is the value of the work certified to date as a percentage of total contract price. But if your revenue pattern is same over the period of time, in that case, you can recognize your revenue on straight line basis. If you cannot determine the progress either through input method, either through output method, in that case, you will recognize your revenue only to the extent of contract cost incurred that will probably be recoverable. The cost which you have incurred till now, you will only recognize the revenue according to up to the limit of that cost. Now, how it will be presented in your statement of profit and loss? First of all, revenue. Total price times percentage of progress till today minus revenue recognized in previous period. That would be your revenue. Then cost of sales. Total cost times percentage of progress minus cost charged in previous period. Remaining is your profit figure. Then presentation in statement of financial position. At the end of every year, either you have contract asset or you have contract liability, and its calculation is done through this formula. Cost incurred to date. For these things, you are supposed to cram these formulas. Plus profit to date, which we have calculated in previous slides. Loss to date, less amount billed to date, the amount for which you have issued the bill to your customer, and the remaining would be your current asset or current liability related to revenue from contracts with customers. That's it for today's session. Tomorrow we will discuss some other areas like we will discuss provisions and contingent liabilities, ratios analysis, statement of cash flows, and consolidated financial statements. Those areas we will discuss in tomorrow's session.